Trump's big, beautiful bill officially passed last week. So what does this mean for you, your retirement, taxes, healthcare, and even your investments? I dove into the bill so that you didn't have to. Welcome. And what I've noticed was that doing a ton of research for this is that there's plenty of articles summarizing all the benefits of the bill, but there are very few articles out there that talk about what this means for your retirement and what actionable steps you need to be thinking about making right now to take full advantage of that, to adapt to your plan, to adjust. And that's the purpose of this video, is to figure out what you need to do now that this bill became a law. I'm Nick Covio, certified financial planner and founder of Swell Financial. Now, from a planner's perspective, what I appreciate most about this bill is that it finally gives us some clarity that we haven't had in a lot of years around key tax rates, what they're going to be. And you'll hear later on in this video what we can do with that clarity around things like tax planning around Roth conversions. Second, it passed in early July and it takes effect this year, which means it gives us plenty of time to plan before the end of the year. Before we dive into the one big, beautiful bill, it's important to first understand history and know the Tax Cut and Jobs Act. I refer to that as TCJA, which was passed during President Trump's first term in office. Now, that bill significantly lowered both personal and corporate tax brackets. It doubled the standard deduction, and it gave us some of the most powerful tax and estate planning tools. Now, in order for the TCJA back in 2017 to get passed, Congress had to come to terms, and so most of those tax changes, which lowered rates, were set to expire after 10 years, and that would have been 2025. This is really important. And now with the passing of this new big, beautiful bill, it locks in a lot of those tax cuts now as permanent. Now, I use the word permanent lightly because we know Congress can always rewrite the rules depending on the current administration. Here's what we know. Lower tax rates are here to stay. We can see here on the screen what they would have been had the bill not passed and what they are going to be now into the foreseeable future. And this is really good news for retirees and high earners, and it gives us a solid runway to plan around. So let's dive in. So not only are tax brackets staying lower, as I just mentioned, but the standard deduction is also getting that boost. Starting this year, the new base deductions will be $15,750 for single files, which is up from $14,600, and $31,500 for married couples, up from $29,200. And remember, if you're over 65, you still get that extra bump of $2,000 for single filers and $1,600 per person for married filers, which is $3,200. That's significant tax savings, what I like to call free deductions. Now, what I also want to talk about is for those over 65, you'll also get what I like to refer to as the super senior tax deduction, which we'll talk about more later. But in short, it's $6,000 per person, $12,000 per couple. And so with the combination of these larger deductions, not only will it help you reduce taxable income, it's going to create significant savings. Let's take a look at an example. So as you'll see here on the screen, let's say you're single, 65 or older, and receiving about the average Social Security benefit, which is about $2,000 a month or $24,000 a year. Now, normally, 85 or up to 85% of that, because Social Security has its own special taxation, would be taxable. So about $20,400 would be taxable. But under the new law, you now get the $15,750 standard deduction, $2,000 age-based deduction for being over 65, and now $6,000 senior bonus deduction, which totals almost $24,000, which completely wipes out your taxable income from Social Security. Now, if we're to look at a married couple, both over 65, bringing in $120,000 a year from portfolio income, including Social Security, their new deduction breakdown looks something like this. Well, they each get that $6,000, I'll call it the super senior discount, $31,500 standard deduction, plus their age-based deduction of $3,200 combined, $1,600 each, totaling up to $46,700 in deductions, previously up from $34,700. This is a massive tax cut, and it significantly lowers how much they'll owe in taxes. And so, bottom line here, most retirees will now owe little to nothing on their Social Security benefits. And this one change alone is expected to increase the number of retirees not paying taxes on Social Security up from 64% to as high as 88% over the next few years. Now, really important caveat that I want you to pay attention to here, this deduction is temporary. And it only applies for tax years 2025 through 2028. So we got 4 years, and you have to be over 65 or older to qualify. And as I mentioned earlier, your income has to stay under those thresholds of 75,000 or less if you're single, 150,000 or less if you're married. But regardless, this is a powerful planning window. And I want to make sure that you get that full benefit over these next 4 years. And we do the tax planning. For me, I think of Roth conversions and capital gain harvesting. Because of these wider and now lower tax brackets, we're seeing a lot of tax planning opportunities for those who find themselves sandwiched between the 22 and 24% tax bracket. Now, those below the 22 and 24, a lot of tax planning opportunity, but now because we have these wider ranges, those in the 22 to 24 gives us a lot more breathing room to do what's called bracket filling. This allows us now to be able to look at a partial Roth conversion and say, how much can we convert into a Roth IRA before we hit that next tax bracket? And this is especially important knowing that we only have these special deductions that I mentioned earlier for 4 years from 2025 to 2028. Second, with all these deductions, this now creates so much more room for us to potentially trigger more in capital gains. Capital gains, they have their own tax rates different from Social Security, different from ordinary income. And if our income in retirement is only based off Social Security and capital gains, we now have a little more wiggle room with all these deductions to be able to potentially pay 0% in capital gains, or if we go over, a very small portion attributable at 15%. So this creates a lot of planning room for us to be able to look at to see how can we maximize those benefits for you and therefore pay less in taxes. Now, here's where I think things get really interesting because of all these deductions, right? So when we combine the higher standard deduction, the new Social Security deduction of $6,000 per person, $12,000 per married couple, and then the senior deduction of $1,600 or $3,200 for couple, this is now where the idea of bunching our charitable deductions is really, really impactful. This is this idea where rather than giving $1,000 a year, $5,000 a year, what if you were to give multiple years all at once? Because what we are able to do now is this creates a tax planning opportunity or window to say, what if we were going to give the money that we had planned and anticipated anyway over these next couple of years? We'll pull it all together. This can now become a very effective way to either maximize your tax benefit or create an even bigger window and opportunity for Roth conversions. Now, for those thinking about legacy planning, good news here too as well. Starting in 2026, the federal estate tax exemption is increasing to $15 million per person, $30 million per couple. That's here to stay. And this amount will be indexed and adjusted annually for inflation. And so that is a lot of room for tax-free transfers of your wealth to family members, kids, whomever. And this is a big relief compared to what it used to be back in 2016 and earlier at $5 million cap. And if we go back even further to the early 2000s, it was only $675,000. And that's a lot of money that is now passed tax-free, whereas before any amount over that previous limit could be taxed up to 40% on the federal side, which is really, really high. Now, for higher income earners and those living in high tax states, California, New York, the state and local tax deduction, you know this as the SALT cap, it's increasing, good news here, from $10,000 up to $40,000 for itemizers through 2029. So it is temporary and it's only going to be around for the next several years. It also, worth noting, it does phase out once your income gets above $500,000, and it's planning on reverting back to that $10,000 again in 2030 unless Congress makes any changes. For the healthcare side, this is where some of the cuts occurred to help fund the bill. And so this part is especially important for our early retirees that are relying on Obamacare or the ACA tax premium subsidies before Medicare kicks in at 65. So starting in 2026, with the expiration of the American Rescue Plan, we know income cliffs are going to come back, which means as a retiree before 65, if you're earning more than 4.5 times the federal poverty levels you'll see here on the screen, you run the risk of losing those really valuable ACA subsidies, which means now those premiums for healthcare pre-65 are going to get a lot more expensive. And this is something you're now going to have to factor into your retirement modeling, into your spending. And so if we're retiring pre-65 and we're relying on that coverage, this could materially affect whether or not you can retire early. And so if you're planning to retire before age 65, this is where we need to sit down and run the numbers, because we may no longer be able to rely on that ACA coverage the same way you used to be in the past, which means there's going to be a big spike, possibly, in our healthcare costs, and we need to have a plan to adjust for that. This bill is expensive, and it's expected to add $3 trillion to the federal deficit over the next 10 years. And as a planner working exclusively with retirees, what we're personally watching out for is, well, as the federal deficit grows, in order to cover that deficit, the government has to borrow more money. And what do they do to do that? Well, they issue more treasury bonds. But here's the problem. When there's more borrowing, what happens? Supply goes up. And in order to entice new buyers of those bonds, the government has to offer higher interest rates to attract those buyers. And if that dries up, this could lead to higher treasury yields. That can cause a ripple effect in the bond market and a lot of volatility around price. And we don't like that. And so while your plan may not change overnight, you need to closely monitor these trends, especially if you're holding bonds and fixed income in your portfolio. Now, the second thing that we need to be aware of because of this growing deficit are future changes to either tax rates or entitlement reforms, such as changes to Social Security or even more to Medicare, to be able to close this fiscal gap. And so now these are very important things to monitor when you're retired and when your portfolio needs to provide you with a stable and consistent income. Yes, we'll take the bigger tax deductions and the lower tax rates, but we have to understand the cost of what it comes at, and therefore how to build a retirement plan and investment portfolio that's resilient. Regardless, there are plenty of tax opportunities today that we've named here in this video that we can incorporate into your financial plan, whether that's updating your tax projections for 2025 and beyond, adjusting your Roth conversion strategies or bracket filling strategies with capped gains, and sending more of your income now in that lower tax bracket. So I've named a number of tax planning opportunities and things we can do to incorporate these changes into your financial plan. Hope you found this video to be helpful. Looking forward to seeing you at the next video.